What if I told you that you really do live in the Matrix and that everything that you have come to accept as reality is a lie? Well, that's certainly true when it comes to banking. Watch to the end of this video to see exactly how you're being taken financial advantage of and what you can do to fix it. Paying off debt seems simple enough, but for most people, myself included, no one ever sat us down and explained to us that banks are businesses, not nonprofit organizations. I'm not saying that banks are evil. I'm saying that banks are capitalistic organizations with the primary goal of making money off their customers, you. I want to share one example that should illustrate this point quite clearly and hopefully lead you to the same conclusion that I had when I saw it for the first time, and that is question everything. The example that I'm going to use is for hypothetical purposes, to illustrate an average American family using common banking products and the long-term effects that that has on their finances. Okay, let's say our hypothetical average American household makes about 60 grand a year. That's $5,000 a month. So when they get their money from their job, what type of bank account do most people put it in? Checking and savings, right? One of the drawbacks of putting your money into a checking account is that it keeps you on a cash basis. When you're on a cash basis, you have to slice up the pie in your head, sometimes before the check even gets there, and think, okay, I've got a house payment coming due. I've got to slice that piece of the pie out. No one can eat that piece of pie because that's for the bank. I've got a car payment that's coming due. I've got credit cards that I have to pay the payments on. I've got to set aside all those slices of the pie, and no one can touch them because they're for the bank. Let's move on to interest for a moment. You'll see that in our hypothetical family's finances, we've got a couple of interest rates on the screen here. Some are at 6% over on the loan side. We've got a 21% on the line of credit side with the credit card. If the bank came to you and gave you a choice between paying 6% interest on borrowed money versus 21% interest, which would you pick? Did you say 6%? I think most people would. It's actually a trick question. Let me use another example to make my point here. If I told you that 32 degrees was the freezing point of fresh water at sea level, is that a true statement? If you said no, you were correct, because I was using the Celsius system. You see, I left off something very important when I showed you this graphic. I didn't tell you the scale or the system of measurement that I was using ahead of time. Now, this is a true statement. 32 degrees Fahrenheit and 0 degrees Celsius is the freezing point of fresh water at sea level. That's absolutely true. But what happens if I do this? Which one's hotter? Wait, 1 is hotter than 32? How could 1 be hotter than 32? It's a lower number. It's a different scale. It's a different system. Guess what? That's what the bank's doing to us. Here's what I mean. Anything called a loan, by definition, is amortized interest and one-directional in nature. That means you pay it and that's it. Anything called a line or a line of credit, by definition, is daily simple interest and revolving. A credit card is an example of a line of credit, and if you've maxed out your credit card and you make a payment, that's going to open up a little bit of room on that credit card. We call that room leverage. And you can take that leverage in the form of the little piece of plastic down to the gas station, and you can swipe and put some gas in your car. So the payment literally was reused to put gas in your car. That's pretty normal. But when was the last time you ever swiped your mortgage to buy gas? You can't, because it's a loan and it's one-directional by nature. You pay it and that's it. So what about amortization? What's that? Let's use our hypothetical family's house as an example. On this $200,000 mortgage at 6% interest, average payments would be about $1,200 per month. So they buy this house, they move in, and they make their first payment of $1,200. A couple of days later, the bank sends them a statement in the mail. They look at the statement and it says, we allocated $250 of it to principal and the remaining $950 to interest. Wait a second, I thought we had a 6% mortgage. That doesn't sound right. So they call the bank and they get all mad at them. And the banker says, wait a second, wait. If you turn to page 47 in your statement, you'll see the amortization table. It crisscrosses about halfway through. And actually, by your last payment, it'll be the inverse. So you'll pay $1,200 to your mortgage, but $950 of it will go to principal and $250 of it will go to interest. So it all evens out. Here's what I don't like about that. How many people do you actually know that make it to their last payment on a single mortgage? Most people don't. In fact, the average American refinances their mortgage every 7 years and gets into a new loan that puts them back at the beginning of the amortization schedule, which means they're paying mostly interest their entire lives, which the bank, of course, loves. And you know what? If you get to about 5 to 7 years without refinancing, they'll start calling you because they want to keep you paying mostly interest. That's how the bank makes money. Let's take a look at a 48-month snapshot of our hypothetical family's mortgage. In just the first 4 years of their mortgage, they will pay about $57,000 towards their house. Only $12,000 of that will be reduced from their principal owed on the debt. The other $45,000 will go to interest. All right, so let's talk about this from a cash flow perspective. Remember, to the wealthy, cash flow is king in any financial model. When you pay a loan, regardless of how much is allocated to interest and how much goes to principal, you can't reuse any of it. The principal and the interest disappear. That means 100% of the cash flow from any payment towards a loan disappears. However, with a line of credit, like the one that we used in our example here, the bank only takes their 21% interest. The rest of the principal returns to the line of credit as leverage, and you get to spend that again however you want. 2 rules that I want you to remember. The first rule of velocity banking is that lines are better than loans for all of the reasons that I just described. The second rule is that the employee mindset individual uses cash as currency. They get paid, they keep it on a cash basis in a checking account, and they use that cash to pay bills and buy stuff. The wealthy don't do it that way. When the wealthy mindset individual gets cash, they throw it all at debt. Imagine how fast you would pay off your mortgage if you took your whole paycheck and threw it at your mortgage. The problem is, because your mortgage is a loan, you don't have any of that money left over to buy gas or groceries or pay your cell phone bill. But when they obey rule number 1 and they keep their debt in lines of credit, they can take the whole paycheck, throw it at the line of credit, lowering the debt balance, thereby paying less in interest because the principal balance is lower, and opening up leverage to pay bills and buy stuff. Now, that may sound overly simplistic, but let's see what happens as we apply it. But first, I know all of this is a lot. You're drinking from the fire hose today. So if you have questions, please put them in the comments section below and I will answer them as quickly as possible. Or for a more interactive approach, you can schedule a free one-on-one strategy call with one of our elite Flippin' with Mitch and Maley coaches. Just go to flippin.education or click the link below. All right, let's get back to it. So when our little family gets paid, now with the velocity banking strategy, they're going to bypass the checking account completely. They throw all of their paycheck at the line of credit, and a couple of really cool things start to happen. First, the bank wanted to see a $600 minimum payment come in for the credit card. Our family just gave them $5 grand. That covers the minimum payment 9-fold. Now they're going to do it the next month, and the next month, and the next month, and so on. Will the bank ever come back to them for that payment again? Not if they keep it up. So do they even have to budget for it? The answer is no. So $600 just went right to their cash flow. Also, I think I've made it pretty clear on this channel that the accumulation strategy is dumb. Savings accounts are for chumps. Let's add that to the $600 in cash flow they picked up by starting to deposit their money into the line of credit instead of checking, and now they just found a total of $2,000 a month in cash flow. They still have some payments that they need to make, and they still have a lifestyle that they want to maintain, so we don't adjust their lifestyle, we'll just leave that the same. To review where they're at right now, that makes it $5,000 a month in income and $3,000 out, leaving $2,000 a month going towards cash flow. When cash flow increases, velocity increases, and they start paying off their debt even faster. They had $12,000 worth of debt on their line of credit, and they threw $5,000 in. That went down. They have $3,000 in bills over the course of the month, so it goes back up a little bit. That's month 1. All we have to do is repeat this process over and over again. At this point, you might still be stuck on the fact that I told this family not to save anymore. What happens if there's an emergency? Well, throwing all of their money at the line of credit created leverage. Do emergency rooms take credit cards? Yep. Do tire shops take credit cards? Uh-huh. Even if they have an emergency that only takes cash, they can still use the credit card down at the ATM, slide it, and pull some cash out of the line. When there's no emergency, which, let's be honest, is most of the time, they just keep doing what they're doing, lowering the principal balance, using the power of the whole pie of their income. Before they started this process, they had $12,000 in debt on the card. They were attacking it with $2,000 a month in cash flow. $12,000 divided by $2,000 a month, that's 6 months to pay off the entire credit card that would have taken them 7 years by making a minimum payment of $600. And that's without getting a raise at their job or changing their lifestyle. All they did was change their mindset. Now, the bank looks at this and says, man, these guys are really good at this debt stuff. They're using a lot of it, they're paying even more of it off, their credit score's gone through the roof. We're going to give them a credit limit increase. We know as wealthy mindset individuals that credit and lines of credit should only be used for assets or emergencies. That means the bank just gave them $10,000 for their asset and emergency fund. When's the last time that the bank came to you and said, man, you save like a champion, here's 10 grand for your savings account? If they do, you need to let me know in the comments where you bank, because I'd like a piece of that. When we behave like the wealthy mindset, we're rewarded like the wealthy mindset. Okay, our little family has a problem now. They were dumping all of their money into this line of credit because they had their debt there. But they paid the whole credit card down to zero, and the last time I checked, you can't pay a credit card balance below zero. So the money's just gonna start overflowing back into their employee mindset account, their checking and their savings. They don't want that. Now, it's okay because they still have a lot of debt over on the loan side, the 100% cash flow debt. So they start moving some of that debt over to the cheaper side. Have you ever seen those balance transfer checks from the credit card companies in the mail and wonder, why the heck am I getting a check from Discover Card? What am I supposed to do with that? Well, I've got an idea for you. Whatever the amount was that they paid off in the line of credit, in this case, in this example, it was 12 grand. They write on the check $12,000, put the name of the mortgage company, whoever that is. The next day, our little family looks at their account online, and sure enough, the principal balance on their mortgage drops by 12 grand. For the mortgage company, this is the same as cash. But our little family knows that all they did was move that principal from the mortgage over to the line of credit, where they'll just continue to do the same thing that they've been doing. So before, they were able to pay off $12,000 in 6 months. If they do the same thing, they should get the same results. They'll pay off this $12,000 chunk in another 6 months. Remember back to our 48-month snapshot on the mortgage? It took them 4 years and cost them $45,000 in interest to pay off just $12,000 in debt. On the line of credit side, I'm gonna be putting up the math here in a graphic so that you can check my work. $12,000 times 21% annual interest, it only took them 6 months. So let's divide that annual interest by 2. It only cost them $1,200 and 6 months to pay off the same amount of principal. I just saved them more than $43,000 in 3.5 years on their mortgage. All they have to do at this point is repeat the process over and over again until they've paid off their mortgage. If we extrapolate this math, they'll pay off their 30-year mortgage in roughly 5 years. And that's without them getting a raise at their job or changing their lifestyle. Now, if they don't have a mortgage anymore, they don't have a mortgage payment anymore either. So when we start to attack the car loan, they pay that sucker off in 6 months. And when they don't have a car loan anymore, they don't have a car payment anymore. So where does that money go? Cash flow. Every time they pay off a line item of debt, their cash flow goes up. So 6 months to pay off the car, 6 months to pay off the credit card, and 5 years to pay off the mortgage. In just 6 years, this family is completely out of debt, and they never had to get a raise at their job or change their lifestyle. Anybody feeling lied to by the banks at this point? Why didn't they tell us this? They don't tell us because they want our money. I hope you feel like you've gotten some really good value out of watching this video to this point. However, I know a lot of people who come here want to learn about real estate investing strategies. So if you're interested, I'm going to spend the next video talking about how to use this strategy to go to the next level. So you're not going to want to miss it. Make sure you hit that subscribe button and ring the bell so that you're notified when that next video drops in a couple of days. And until then, see you on the flip side.